Before Warren Buffett became one of the richest people in the world, before the headlines, before the billions, he built his entire philosophy around one deceptively simple rule, not a strategy, not a formula, a rule. Buffett has said repeatedly that this single principle matters more than talent, income, or timing. Most people hear it and move on, thinking it's obvious, but they miss what it truly means. This rule quietly separates those who build lasting wealth from those who keep starting over financially. It works whether markets are booming or crashing, and it explains why Buffett succeeded for decades while others came and went. Understanding this rule isn't about getting rich fast. It's about never breaking the foundation that wealth is built on. Before we break this down, make sure you like, subscribe, and share this video. This isn't hype or motivation, it's a practical wealth principle used by one of the most successful investors in history. And understanding it early can change how you make financial decisions for the rest of your life. The one rule: never lose money, and what Buffett actually means. Warren Buffett's famous rule is simple on the surface. Rule number 1, never lose money. Rule number 2, never forget rule number 1. But Buffett is not saying you must avoid every temporary decline or market fluctuation. What he means is avoiding permanent loss of capital. Temporary drops recover with time, permanent losses destroy time. Buffett's rule exists to keep you in the game long enough for compounding to work. It forces discipline, patience, and selectivity. Every decision is filtered through one question: can this permanently damage my capital? If the answer is yes, Buffett walks away, no matter how attractive the upside looks. This rule is not about fear. It is about survival, consistency, and letting time do the heavy lifting. Why Buffett says this rule is everything. Buffett believes this rule matters more than picking great stocks or finding high returns. Without capital preservation, nothing else works. Once money is permanently lost, compounding stops and time is wasted. Buffett would rather earn moderate returns safely than chase high returns that carry hidden risks. This mindset protects investors from devastating mistakes that set them back years or decades. Many people focus on how much they can make. Buffett focuses on how much he can avoid losing. That single shift changes behavior completely. It eliminates speculation, emotional decisions, and unnecessary risks. Over long periods, this discipline compounds quietly but powerfully. Buffett's success is not built on brilliance. It is built on refusing to make decisions that break rule number 1. Losing money destroys the power of compounding. Compounding only works when capital survives. Buffett often explains this with simple math. If you lose 50% of your money, you now need a 100% gain just to break even. That lost time can never be recovered. This is why Buffett avoids situations where large losses are even possible. He understands that avoiding big mistakes is more important than chasing big wins. Every major loss resets progress and delays financial freedom. Buffett's rule protects the compounding engine by minimizing drawdowns. Instead of asking how fast money can grow, he asks how safely it can survive. Over decades, this conservative approach outperforms aggressive strategies because compounding rewards consistency, not excitement. Preserving capital keeps time on your side. Patience beats talent in wealth. Building Buffett has openly admitted that he is not the smartest investor in the room. What separates him is patience. He waits for opportunities he understands and ignores everything else. This patience is enforced by his one rule. When you refuse to lose money, you automatically avoid impulsive decisions. Many investors fail not because they lack intelligence, but because they lack discipline. They chase trends, react emotionally, and abandon plans too early. Buffett does the opposite. He waits, observes, and acts only when risk is low and understanding is high. Over time, this calm approach compounds results steadily. Buffett's career proves that average intelligence combined with extreme patience can outperform exceptional talent paired with poor judgment. Why risk is not what most people think. Most people define risk as price movement, but Buffett disagrees. To him, volatility is not danger, it is opportunity. Real risk is investing in something you do not understand. When investors buy assets they cannot explain, they expose themselves to permanent loss. Buffett's rule eliminates this risk by demanding clarity before commitment. If he cannot understand how a business makes money, he does not invest, no matter how popular it is. This protects him from hype, speculation, and complex financial products. Understanding reduces uncertainty, and reduced uncertainty protects capital. Buffett's definition of risk shifts responsibility back to the investor. Knowledge, not prediction, is what keeps money safe. Simple businesses protect capital. Better than complex ones, Buffett consistently favors simple, predictable businesses over complex and flashy ones. Simplicity reduces surprises, and surprises cause losses. Businesses with stable demand, clear cash flows, and understandable models align perfectly with Buffett's rule. Complexity hides risks that only appear when it's too late. Buffett avoids industries he cannot easily analyze, even if they promise high returns. This discipline protects his capital across economic cycles. Simple businesses may seem boring, but boredom is often safer than excitement in investing. Over time, durability beats novelty. Buffett's preference for simplicity is not conservative, it is strategic. It ensures that capital stays intact while compounding quietly does its work. Time in the market matters more than timing. The market Buffett does not attempt to predict market crashes or short-term movements. Timing increases the chance of mistakes that violate his one rule. Instead, he focuses on staying invested in high-quality assets for long periods. Market downturns do not scare him because his capital is protected by strong fundamentals. This allows time to work in his favor. Missing just a few good years due to poor timing can severely reduce long-term returns. Buffett's approach removes this risk entirely. By prioritizing endurance over precision, he lets compounding operate uninterrupted. His fortune was not built by perfect timing. It was built by staying invested safely for decades. Emotional control is the real competitive advantage. Warren Buffett has often said that investing is not an intellectual game, it's an emotional one. Most people lose money not because they lack information, but because they panic, chase excitement, or react to fear. Buffett's one rule forces emotional discipline. When markets fall, fear pushes people to sell at the worst time. When markets rise, greed pushes them to overpay. Buffett does neither. He remains calm because his decisions are grounded in understanding, not emotion. Emotional control allows him to think long-term while others think moment to moment. This advantage compounds over decades. By refusing to act emotionally, Buffett avoids mistakes that permanently damage capital. In investing, staying rational when others are irrational is often the difference between wealth and regret. Why cash is a weapon, not a waste. Many investors believe holding cash is unproductive, but Buffett views cash as strategic power. Cash provides flexibility and protection. When markets crash, opportunities appear, but only for those who have capital available. Buffett keeps cash, not to earn interest, but to avoid being forced into bad decisions. Debt and overinvestment remove options. Cash restores them. This aligns perfectly with his one rule. When others are selling out of desperation, Buffett can buy calmly and selectively. Cash prevents permanent loss by ensuring you never have to sell at the wrong time. In Buffett's philosophy, cash is not inactivity, it is preparation. It allows patience to turn into opportunity when conditions finally favor disciplined investors. Debt is the fastest way to break the rule. Buffett has always been cautious with debt because leverage magnifies mistakes. While debt can increase gains, it also increases the chance of permanent loss. Even good investments can fail when combined with excessive borrowing. Buffett avoids unnecessary leverage because it removes control during downturns. When markets fall, debt forces decisions under pressure, often at the worst possible time. This violates the core rule of protecting capital. Buffett prefers slower growth with certainty over faster growth with fragility. Debt turns small errors into irreversible damage. By minimizing leverage, Buffett ensures survival during crises. His philosophy prioritizes staying in the game over maximizing short-term returns, and avoiding debt plays a critical role in that longevity. Wealth is built quietly, not quickly. Buffett's fortune was not created by a few lucky bets. It was built slowly through decades of consistent behavior. Most people underestimate how long real wealth takes to form. Buffett's rule eliminates impatience by focusing on preservation first. When capital stays intact, progress compounds invisibly. There are no dramatic moments, only steady growth. This quiet approach often looks boring compared to speculative success stories, but it is far more reliable. Buffett's lifestyle and strategy reflect this patience. He avoided shortcuts, hype, and trends. Over time, consistency proved unbeatable. Wealth built quietly tends to last, while wealth built quickly often disappears just as fast. Most people fail because they break the rule. Early, many investors start with good intentions but abandon discipline under pressure. They chase trends, speculate, or overextend, all of which violate Buffett's one rule. Early losses damage confidence and capital simultaneously. Buffett avoids this by filtering every decision through capital preservation. He understands that one bad mistake can erase years of progress. Most people don't fail because they lack opportunity. They fail because they ignore risk until it's too late. Buffett's rule acts as a protective barrier against self-sabotage. It removes temptation by setting a clear boundary. If a decision threatens permanent loss, it's rejected. This clarity is why Buffett survives, while others reset repeatedly. The millionaire difference is behavior, not income. Buffett proves that wealth is not determined by how much you earn, but by how you behave with what you keep. Many high-income earners remain broke because they violate the one rule through poor decisions. Meanwhile, disciplined individuals with modest incomes quietly build wealth over time. Behavior compounds just like money. Buffett's rule encourages humility, patience, and consistency. It removes ego from financial decisions. Wealth becomes a byproduct of good habits rather than lucky breaks. Anyone can follow this rule, but few do because it requires restraint. Buffett's success shows that millionaire status is less about opportunity and more about discipline repeated consistently over time. Warren Buffett's one rule isn't exciting, trendy, or fast, but it works. It doesn't promise overnight success. It promises survival, stability, and growth over time. By protecting capital, controlling emotion, and respecting compounding, Buffett built a fortune that lasted decades. Anyone can follow this rule, regardless of income or background. The challenge isn't understanding it, it's respecting it long enough for results to appear. Those who do quietly build wealth. Those who don't keep starting over. And that simple difference explains why this one rule still turns ordinary people into millionaires.